You're
Okay.
one of the liquidity experts that really talks about liquidity from different aspects, and I'm sure everyone's going to like it. And I hope everyone's gonna. This will be their last episode learning about liquidity.
Yeah. I mean, I don't want to put you out of a podcast business. I don't know if you want it to be the absolute last episode.
I've watched a lot of videos before I invited you on the show, and everyone from those videos I watched, everyone was really focused on volume being the key factor for liquidity and the highs and lows. So let me start by asking this a very simple question, right? Very simple question.
Yeah.
How do you define, for someone who's new to the market, who's not spent
Yeah.
time, how do you define liquidity?
Right. So I think I would say that walking in, everyone probably has an intuitive understanding of what liquidity is just by virtue of the word.
Hmm.
It's something, it's liquid, something's flowing, something's moving. And in the market, it really just means that things are flowing and moving appropriately
Right.
or smoothly. And I guess if you want it to whittle down with some market terms, I think the best description of liquidity is simply the thing that allows the bid and the ask to
Right.
agree smoothly, right? If there's no liquidity for some reason, then the two parties, they just can't meet. One of them can't meet their obligations or their preferred trades, and so things stop flowing appropriately. And so, yeah, I think that would be like the general kind of rule of thumb. When things are running good, people typically say that there's good liquidity. If things are starting to not run good, people typically describe that as not a liquid environment.
Right.
So,
Right. And this is a very simple definition. We're gonna go into details here. That applies to everything, right? Even though we are talking about, markets, right? A market could be, as simple as eBay, right? An auction platform. If there is liquidity, you should be able to sell pretty quickly. If something is liquid, it will take you some time, or you might not be able to sell it, right? So
right.
for this instance, we want to focus on the capital market. So you define two things, like, good liquidity, bad liquidity, right?
Right.
And what does that mean, like in very simple terms, good and bad liquidity, and how does like can we see it? Like how do we know it's good or bad as retail investors?
Right. That's the $1 million question, right? So first, yeah, let's break down a little bit more of like what is it to have good liquidity, and let's go through an example, right? So let's say that you have a bit bullish outlook for a given equity, and so you want to start purchasing a large quantity of shares. You want to get a large stake in this.
Mhm.
Ideally, for you would like to be able to do this while not moving the price up, right? Because you want to keep your entry price as low as possible so that you can sell for the greatest amount of profit in the future.
Mhm.
In this scenario, the bid would consider it to be a liquid environment if that could happen. Can I put a large bid into the market and not cause significant slippage, to not cause significant price variance? And so if I can, then it's a liquid environment. And then so how does that relate to like our initial definition? Well, I had a function or a activity in the market and it went smoothly. It happened smoothly. I was able to get my entry price where I wanted it, when I wanted it, and now I'm set. Anything other than that is bad liquidity.
It's bad liquidity.
Right. So it's that, right. So if there's any hiccup, any turbulence, difficulty finding counterparties, difficulty with slippage, all of those are consequences of the poor liquidity present in that particular equity at that given time.
Right.
So, yeah.
Interesting.
So I feel like it's not as, but in that way though, I feel like it's not as complicated as people as at first seen, because it's really like you can either do what you want when you want, or you can't. There's no real.
There are no tools as such that I can go to. There's no single tool, I meant to say, that I can go to look at that overall market liquidity, how liquid the market is, right? Or if
Except for,
yeah, except
except for LDPM and ODPS.
right,
Right. But yes, and I would say traditionally there is no one tool
right,
that can really capture this the view, because really, and as we'll get into later, each traditional tool of measuring liquidity is kind of from a different angle, and
right.
it can be hard to overlap them to get a full picture view of the market.
Mm,
And I think it's in that difficulty that people have this idea that liquidity is itself complex, or it must be complex if it's hard to see.
mm,
Not, I don't think that's true. Because again, things are either happening in a way that everyone is happy, and so things are liquid, or things are happening in a way that not everyone's happy, and so things aren't liquid.
right.
And so it's really, and then so you really just have to like kind of create a tool that can identify two groups of things happening at once, and then figure out which one looks more like good and bad liquidity. And no tradition. I would argue, yeah, no, there's no traditional tool currently that can piece that together.
Right, right,
Yeah.
right. So the
Mm-hmm.
question I think I had was like if there's a way to track market liquidity, or if there's a way to track like individual, asset that you're perhaps wanting to see if they're liquid or illiquid, or compare them to each other.
I mean, I think yes. The I'm going to default again to that's the beauty of ODPM and LDPS
Right.
is, and we'll get into kind of like, well, we're kind of getting into it now because a
Yeah.
core principle of those tools is that one, that there is a market liquidity state, right? All of the individual tools currently present in the traditional space for measuring volatility are from a very specific angle, and so everyone's kind of has their own description of what good liquidity is, what the consequence of good liquidity is, but I kind of rejected that.
Mm,
I assumed that if the market has liquidity, then the market itself is either liquid or not. It shouldn't matter where I'm viewing the market from, right? It should always have a stated amount of liquidity.
I see.
In other, and
Right,
so yeah, and it's actually just that assumption that kind of like things start snowballing.
right, right, right. So you're defining something very, very critical here. You're saying the markets are the way, because I think we might have to define markets, right?
Yeah.
You're defining markets, that if markets are considered to be liquid, then you can fairly, with high confidence, can say certain assets are liquid. Is that how you sort of saying it? Yeah.
Yeah, I think because if you can develop a tool, or if you have a view or a concept of liquidity that is, it's like you kind of said earlier, where you
Yeah.
can just apply it to a specific equity and then another, and those are you can directly compare those two values, because
I see.
what you're measuring is you're just kind of measuring a subset of the market, but your tool has the entire market kind of like in mind. It's designed,
Right.
uh, you know, so for instance, it doesn't, if I asked you how much water is in a given pool, it LDPM and LDPS, it wouldn't matter if you put it in the shallow end or the deep end. It will tell you how much water is in the pool.
Right.
Is some of these ideas of volatility, if you put that tool in the shallow end, it's going to give you a significantly different. It's only going to see the shallow end in a sense.
I see.
So it's going to be dependent like where you put it to measure the liquidity.
Right.
LDPM and LDPS don't suffer from that. You can just throw it in.
I see.
And
So
it'll tell
these
you.
are the two tools that as part of the portfolio that you have within the deep dive stocks, right? So I want to get into it, but given we defined or we opened up to this term markets, right? And when you talk about markets, you have different players in the markets, right? And
Mhm.
liquidity for different players will differ, right? This is a simple example I'm using, but if I'm a retail investor, I want to sell, I don't know, like a one Apple stock or 10 Apple stocks. It's trading at $200 each stock. 10 will be $2,000, right? For me, I think it's very, very liquid condition, right? For me as a retail
Mhm.
trader, I can go out and I can sell. Like a very simple example, right? But if I'm a hedge fund or a pension fund and I hold 10 million Apple stocks, right? For them, the consideration might
Right.
be different, right? For them, it's
Right.
right. I'm not the one to tell them, because if they try to sell in open market, the price will jump hugely, right? And so I wanted to introduce this concept of, hey, there are different players in the markets, and they all have,
Mm-hmm.
they all view liquidity from their perspective, perhaps along with the markets, right?
Right. And and I think that ties directly into the idea that kind of there's all these disparse but somewhat similar definitions of liquidity. Each practitioner, you have the market maker, the options dealer, their concept of liquidity is totally different, because they're dealing with, their foot is in the derivative space and the equity space. Futures, they have, the different views. Commodities futures have a crazy view of liquidity. They're definitely in the camp of, it's liquid if I can enter or exit a position without causing like too much disturbances. And that type of framework makes sense when you're moving large money, that, if you get stuck with 10 futures contracts for 10,000 eggs, and you don't have a place to put those 10,000 eggs, right? Like, so they're interested in, can I get out of this obligation? If so, can I do it, please, now? But that's totally, like you said, that's totally different from from a retailer's understanding of liquidity, or like even the type of liquidity that affects me. I will always be able to enter and exit my positions, right? Like you mentioned, I can tap the dark market, if needed. Some broker will be absolutely willing to give me my 10 shares of Apple, So my concept of liquidity is probably going to lean more towards, price variance, like how much is price moving, how much volume is there.
Right.
So yeah, I think, and that's what I think, trying to figure out what liquidity is so difficult, because, every kind of small, or every subgroup of the market has their own definition of liquidity, and it's the definition that is like most impactful to them. It's kind of, to me, I think I see them as like their specialized definitions. There's special use cases. But as I hopefully bring up later on, like we'll see that those definitions work in those contexts. But if we start looking at broader market behavior, that's where some of these like frameworks for liquidity start to fall.
Yeah. So, Justin, can we bring all these participants in the market, right? I think, again, even though it's so common knowledge, but I think a lot of people, especially in the crypto space, don't think about there are more players than just retail doing the buying and selling, right? So can we bring all the players that are in the market?
I think one of the first ways that we can kind of group all of the players is if they are price sensitive or not. Okay. And a price sensitive party in the market is interested in transacting at a specific spot, in parentheses, for a specific spot. So they want my obligation to trade, whatever the obligation is, whether it's, because I just personal, I want to do it, or I have a standing order from my clients. I am price sensitive, so I need to transact within a certain price range. And so these are your value seekers, your, Warren Buffett's. I don't know if I'm going to put market makers in there, but they are technically price sensitive, as they add the liquidity to the market. They don't want to just add liquidity and get nothing back, right? They are interested in getting a little bit of a profit. And I would say maybe you could put short sellers in there. Short sellers are price sensitive. Like when they're entering or exiting, because if a short is getting squeezed, it's obviously going to be very concerned about the price. It absolutely wants to transact at a lower spot as possible. So that's kind of like your first sphere. You have these price sensitive parties, and they kind of are defined and characterized because they hang out at their respective side of the book. Except for the shorters there, because they get a little eager, right? We can get more into that, but let's move on to the next group before I start. So then you have your price insensitive parties, and these are parties that are trading and transacting not for the value of the underlying itself, but for what the possession or what that position of the underlying kind of represents. A classic example is options dealers. So, So as I buy and sell options, and I need to maintain that neutrality, I need to buy and sell shares of the underlying equity.
Right.
And so the purpose of me transacting isn't value driven. I'm not transacting shares because I think that there's a value in it. I'm transacting them as a risk management scheme.
See.
So in theory, it doesn't matter when I transact or at which price I transact these shares. It's simply that I either need them or I don't. And if I don't need them, then I just need to get rid of them. And so I think,
such a good point you brought up there. And I like the distinction you're making here. We want to have a session with you on options because that's the key for where you spend majority of your time, along with liquidity. So that's a separate discussion I love to have later on. But yeah, you brought up such an important point there, right? If I'm managing a portfolio of options, right? It could be individual option, right? If I'm a broker dealer, right? JP Morgan, Goldman Sachs, right? Whatever, these massive broker dealers, they could manage one option, or they could have a portfolio of options, right? A portfolio of assets they manage and as one option bucket, let's call them. If they want to exit their position or change the dynamic of their option portfolio, right? They need to exit their underlying, right, one way or another, right? And that's what you're defining, right? That they are insensitive to the price movements. They just have to execute certain things that they need to execute.
Right. Like it's not to say that there may not be, consequences for if they're trying to manage these obligations and price keeps changing. But as long as it stands that basically it doesn't matter what the price, they can bitch about the price if they want, but they have to get these hedging and like they either have to offload this exposure or get this exposure. That's a no if, buts, or ors about it, right? Because, and in a few talks, because this brings up one of the main things that a lot of liquidity metrics miss, I call it the opportunity cost. And so, or the opportunity or the obligation cost. And the idea is that, JP Morgan with their portfolio of options that maybe suddenly changed, now they have to switch their hedging exposures. That is an obligation. And the market is going to sniff that obligation out if it can, because where there's if there's a demand, if I both need to get rid of shares and the shares are trading at spot, and I am the counterparty and I can help you with your position. Your position is the value of spot plus how much you need to get rid of these shares. Right. Exactly. That's the true value. And that's where the market will attempt to go. So there, and that's what a lot of these, I think as we get a comprehensive view of liquidity, we're going to start looking at the market is really good at being able to sniff out these, the obligation costs and obligation durations, because it's what the market does, right? But yeah, so there's a price sensitive. So you have price sensitive parties, you have the price insensitive parties, and I think those are like the two main players, right? Or the two main groups, and then
you'll put retail as a price sensitive party, right?
Yeah. I think retail is price sensitive for sure. Because typically, so what is price sensitive? But we can even hash that out some more. So we have two sides of the book. We have the ask and we have the bid. And if I'm a price sensitive bid, what does that mean? What am I doing? So what am I doing as a price sensitive bid? I'm basically biding my time. I want my goal is to buy low and sell high, right?
Right.
So, but the thing is, that's a path independent process. So, for instance, say that I think there's a particular stock in 10 years is going to go up 200%.
Right.
That says nothing about the time between that, right? So if it's at 5 years and the price is the same, or maybe even a little higher, but I think it'll go lower, but my goal is still that the original target.
Right.
There's no onus for me to bid at any point, right? Is if I think there's a near-term downside, buy the dip. So that's kind of how I see it. When I call these parties the organic bid, they're kind of the baseline. They're more than happy to sit at their value price, and regardless of what the actual price is doing, but when it touches the value price, they bid. And it's as long as their outlook is still bullish on a larger time horizon than is like currently happening, they're going to be there. They're going to be this organic bid just sitting there waiting to buy stuff up.
So it just
The
creates the depth on the order book, right? That's what you're saying. It just sits there on the
right,
order book without getting executed because they're not in the rush to get it going, right?
right. But there's a fun consequence of that. The consequence of that is, so what would the organic bid prefer?
Mm.
Up until up until the organic bid's expectant like expiration or the
Right.
time, right? The 10 years,
Mm.
the organic bid, as long as his price point is the same,
Mm.
the organic bid doesn't mind if the price falls.
Right.
That's just more of a discount, right?
Yes.
So, and I bring that up because I think in traditional conversations about the bid, they always, the bid is always perceived as being a bullish force.
Yeah. I see
And
it.
it can be,
Yeah.
but I'm going to argue for later conversations that it's the price insensitive bids that are the ones that drive price up.
Okay.
The organic bids, they don't necessarily actually, that's not true. You will see the organic bids step down if they notice obligation entering the market.
Yeah.
That's what they want, right? So they want to buy low, sell high. So they don't mind if it keeps going lower.
Yeah. Yeah.
But then you have the organic ask, and it's kind of strangely reversed. What does the ask want? Well, the ask wants to be able to sell higher. They are typically already either they have it, the equity, or they're shorting it.
Yeah.
So an organic ask is actually quite bullish if you have a predominance of an organic ask, because they'll drive the price up. They'll step back as the bid bites and chews up. And it's what they want. That ask wants to go higher so that they can sell higher, right? And then plummet down to the organic floor.
I see.
So those are your two
different
main characters.
Categories, right? So Justin, let's get into the factors for you, right? Given you build these tools, right? How do you what are the factors that contribute to liquidity, right? We can see it from different perspective. There are different players and they have roles in the game. I'm calling a game, right? Markets are a game, right? And so what are the things you look at, right? You've got a whiteboard that you prepared for us.
Yeah. So we can let's look at if you do research on, or look up the internet and ask what liquidity is, you, along with a lot of kind of various answers, I think can group a lot of the answers into these three ideas. Mm-hmm. And the first one you typically will see is this, liquidity is inverse to volatility. The second one is, and we mentioned it kind of earlier, that liquidity is associated with how well can I enter and exit a position. Mm-hmm. And the third one, as you mentioned, is that liquidity is essentially volume. We can almost, the idea is that we can assess what liquidity is almost directly from volume. Mm-hmm. So I thought we could look at each one of these and again, kind of examine what it is that they're measuring. Why are they measuring it? And, where are the holes in those ideas? So yeah, we can.
I have never heard liquidity is inverse to volatility.
Oh yeah, no, yeah. So the idea is volatility. So high volatility equals low liquidity, and that's the main idea. And actually, that's so why, right? So if we're sitting here, we're going why would this be the case? And it comes down to the idea of if I want to sell some apples, right, and I want to sell the apples at $5, let's say. That's my, but if there's good liquidity, the idea is that I should be able to just walk into the market and immediately sell my apple. Right. And then it just goes away. Yeah. But if there's, suppose though that I'm the ask, right? But suppose the bid is nah, apples are really only worth $2. Mm. Well, my understanding is that apples are worth $5. Mm. Their understanding is it's worth $2. Kind of repeating here. And let's say the market is trading at, we can even do right in the middle, at $3.75. Right. So there's two kind of activities that could occur here. And the first one, we said if everything was super liquid, I could just come in and say, hey, I want $5 for this apple, and I'd get $5 for my apple. Now, in this non-liquid environment, the price is either going to move from $3.75 to $5 if the bid jumps up to my ask, but so that's really a move from 2 to 5. because if we look at it from the ask perspective, no, the bids,
bids,
or it's right. It or I have to move from the market is going to move from $3.75 to $2, and really what this is a capitulation of $5 to $2 for the ask. And so we see if there was high liquidity, the price doesn't change at all. I come in $5, everything is settled. Like for me, if I come in and it's not a liquid environment, because the only place that someone is willing to buy an apple is at $2, the price is going to move a lot more. So it's that increase in price movement which gives you the volatility.
I get it.
And so so this is the relationship between like high volatility is low liquidity, and that's kind of what a lot of people sort of intuit, is that if things are running smoothly, the price shouldn't be jumping all over the place, right? Like it should kind of have like a nice steady progression.
Another way of putting it, right? Like I like this analogy, and I like this like high volatility equals low liquidity. I think that's a simple way. But other way to look at it is if the spreads are starting to become wider and wider, that leads to the same sort of scenario, right?
Only if the spreads are crossed, and I think that's an interesting.
I see.
What should I say? Like point is that the liquidity is in effect only measurable and present when a transaction is occurring. You can state that there's no liquidity if no transactions are occurring. It's kind of a null state. So if the spread is super wide, right, there's zero liquidity, and so it doesn't really make sense to say like high low is just zero. There's nothing happening. And so
we're trying to define here high volatility equals low liquidity, right? Take example of in traditional stocks we have VIX, right? Just a one measure, right? Or you have IV for individual stocks, right? But on crypto front, right, we don't have implied volatility. So how do we apply that on our front, on the crypto front? Like how do we look at IV equivalent? Is there any factor that's equivalent to IV if you wanted to look at it?
That's it. Price variance. So implied volatility is a strange beast. IV, the VIX, but it's all just kind of made up. And if you look at how it operates, the only real strong correlation implied volatility has is to price variance. It's really good at telling us what current price variance is. And that's quite unfortunate, however, because implied volatility is meant to forecast price variance, and it just doesn't. But it does tell us what it is, in a sense, right? So I would argue that in the crypto space, there's really no need to bemoan the absence of IV or like the VIX, because it isn't predictive at all for anything. And so you're not missing out on that front. And then in terms of like, if you want to like get the information that it is actually measuring well, that's just price variance. You can probably, if you're already in the space of, kind of like in, thinking about that and dealing with it, you can really just do price variance.
So what does that mean, price variance? You're not talking about like highs and lows. Is that how you define it?
High and lows, I think, is probably the best way to measure price variance. Just kind of from like if you really aren't trying to get like nerdy into it. And the idea is if we have two like price curves, and suppose and suppose we have a price curve that's like this. The main thing to notice is that each kind of oscillation, each up and down, is equal. It has equal variance. It's kind of like a normal, it's going back and forth.
I see.
And so if we were to like draw this, actually, we can use this.
But that's never the case in crypto. Have you seen that?
Yeah, right. So like if we were to draw, maybe, and that's probably, I think variance in crypto would probably be a cool thing. So like, if we drew like a line here, we can see that for by and large, the space between the blue and the orange is the same, right? It's the pretty steady variance. But if I had a price curve that was much more like it starts and then it just like starts ramping, right? And it gets huge. Right. So this now is like, so now this is a wide or a large variance, right? Like the price is fluctuating greatly. And what's important to note though is that variance isn't, concerned with the direction of the price. It can be stagnant, it could be up, down, it doesn't matter. It's simply about how much from each measured interval is it kind of moving in relation to how much it moved before.
Right.
And so, yeah. So, and the idea is that if you have a lot of these movements, like if the price is constantly fluctuating, it's because the bid and the ask are constantly having to step over the spread and transact, and that pushes the market then recognizes that value, and then it goes again, and that's a step back. And so now you have these asks in the bid, and these are always the eager parties, because not to cut ahead, but you can guess where the organic parties are sitting, right? Like they're sitting here. Everything in between are these eager parties that are trying to like either exit a position because they have to, or super weird value driven stuff.
Can I bring
you back? So
can I bring you back to this the broader picture you were trying to tell us, that high high volatility equals low liquidity. So are you saying because crypto assets are mostly volatile, they always have low liquidity?
That's an interesting question. And I think, so my answer is no, but I'm going to caveat that with, per this definition of liquidity, that answer is yes.
Right? Oh, I see.
So a consequence of this kind of framework is that crypto is low liquidity. Right. Because you're telling me it has like traditionally high variance, right? So, and that's a direct consequence of kind of this view of liquidity. Yeah. But we can, let's move on. Yeah. So, cool. So you want to move on to the next one?
Yes, please. Yeah.
So that's the first one. And then the second one we touched on, which is the enter and exit. And, the idea of, can I do what I want to do in the market? And that's kind of what this is. Can I do what I want to do when I want to do it?
So enter and exit at any at spot and at any time.
Right. But there's an interesting hiccup with this framework. And it's that if you can only know if something is liquid from the consequences of an action, which is attempting to do what you want to do, then it's impossible to know liquidity beforehand. Right. Yeah. So like a weird consequence of this is that, you just can't measure liquidity. Right. Like that's a weird consequence of this framework.
How can you measure? How can you measure it beforehand?
Right. Like if the only way that my framework understands liquidity is if I can enter and exit, right? Then I only can know liquidity when I'm attempting to enter and exit. Right. And so this framework is interesting because it competes not just with the overall picture of liquidity, but the other kind of more common ways of looking at liquidity. Because this also suggests that price variance has nothing to do with liquidity. Right. Unless it's while you're trying to enter and exit a position, right? And then it's liquid or not liquid for you, so it's a very like narrow view of liquidity. You typically see that with like big money is kind of concerned to commodity or like things that are inherently on the lower liquid side, like commodities and futures, because in those environments, you really don't want to be caught with your pants down. And so of what is of most and utmost concern is simply not getting caught with your pants down. And that equates to, can I enter or exit, positions when I want, how I want? Because, you really don't want to be the futures trader that couldn't get rid of their 1,000 bushel of hay futures, right? And now you got to figure out where to fit 100,000 cubic meters of hay that's about to be delivered to the address on file at the broker. And so if that's your house, and they will deliver it. They absolutely will come to your front lawn and just dump that off, right? And so that's why. But we can see where that just maintaining this view is problematic because again, if you think that liquidity can be measured, then immediately this looks like an incomplete view of liquidity. It's really just like a very specific kind of use case of liquidity. And certainly it suggests that it would be nice to know beforehand if something is liquid or not simply when you need to use the market, right? And so then moving on, we get to the third one. which is kind of just this general idea that things, if they have a high volume, then they must be liquid, right? So just say high volume equals high liquidity. And the rationale here is really that if there's a lot of volume happening, then the chances of me finding a counterparty have increased. So if I have a whole bunch of shares that I want to get rid of, and I see that there's a lot of volume happening, well, then it makes sense that it should be pretty probable that I'm going to be able to get rid of my shares.
Right.
Versus suppose if there's only like 2 people trading, and what if the chances that neither one of them want my shares is much higher. And so, but this becomes problematic because we can consider one ask and one bid at spot, right?
Right.
So this is a transaction, and it occurs at spot between a bid and the ask. But suppose volume is 1, and then suppose that's the only volume throughout the day. So is this
contextual, right? To the person who's selling it and to the person who's buying.
Right. Because think of and a real life example is look at Berkshire Hathaway, right? It has an incredibly high spot value, but it has an incredibly low volume. But you'll notice that orders don't sit long; they're transacted immediately.
Very
right?
fast, yeah.
And so you really don't get that interplay between. You should expect low volume. It's very hard to trade these shares, but Berkshire almost always has good liquidity. There's always probably a standing order somewhere to buy any available Berkshire Hathaway shares, right?
Treasuries, I think, is the same. I feel these are very liquid assets, as we call them, right? There's always a buyer somewhere, even at that high prices, right? You're talking Berkshire is trading at what, 750K, something like that.
Something ridiculous, right? Yeah. And an interesting factoid about that is the reported volume is probably substantially higher than it actually is. When Robinhood started getting into the game, and especially when they got fractional shares, a lot of users started buying fractional shares of Berkshire, but those are reported as full share transactions. So even though I bought 0.00001 Berkshire Hathaway shares, it reports on the tape as one bid, so just one share, and that's how it gets reported with the volume.
Really, that's how it put it on. I did not know.
That, right? I haven't seen it change, but unless fractional share transactions are reported to the whole unit in U.S. markets.
Oh boy,
this is why if you look at fractional share, Robinhood specifically, if you look at when they introduced fractional shares, you'll actually see in the market volume skyrockets, but it's really artificial. It's just that it's just all fractional share purchasing. Right. It's not real full shares.
There are certain assets that are just highly, highly liquid. We call them, right? Treasuries, for example, we call them very liquid, right? You're talking about Berkshire right? They're very liquid. So are we saying these safe assets that, at least the way perhaps the market considers them, the big boys consider them, perhaps is the full variable?
That's interesting. I think that I would be more comfortable at working. I think that is a view to take from this framework for sure, right? But I think as we progress with digging into liquidity, we're going to find it's actually kind of the inverse. We're going to see that the liquid equities and other financial instruments are the safe ones. Right. So we're seeing it from we know, or we have a concept that Apple, the S&P 500 are safe. And it does also look like they have good liquidity. Therefore, is it that safe assets have good liquidity?
I see.
I would actually argue it's the good liquidity promotes being a safe asset. Is Tesla safe right now? Right. Who knows? But it's not, right? Because liquidity, or it should be, because it's been in the zeitgeist as being a safe vehicle, especially a little speculative, but definitely hugely bullish. But I can show you how badly its liquidity has been, and the consequences. I think that the fruits of that bad liquidity are now kind of presenting themselves, Apple's not underperforming, or Apple's not performing like Tesla, and Nvidia's not. Well, I guess everything is down, but like Tesla's big down. And I guess I'm just using that as an example of maybe like something that was in everyone's zeitgeist, is like this idea that it's a safe place to put your money in. But the data kind of were bubbling the whole time that Tesla was not. And I think that the current price action definitely speaks to it. And also probably the future price action.
Right.
So, but yeah,
Okay.
I would say liquid is safe. It does, though, appear from this view that safe is liquid.
So Justin, I think that's beautiful, and I think I'm with you, and I'm happy we defined it further. So what can we do with this, right? Like if I'm a trader, right, and it's mostly the people that really care about these concepts, liquidity, they tend to be traders. Like if I'm long-term holder, I've bought some assets, I'm sitting on that because I have a view the market's going to go up, or that specific asset's going to go up. I don't really care about what's happening in the markets, on the short-term basis, right? But traders do, because they're actively trading day in, day out, or maybe mid-tier trader. What can we do with this knowledge that we're looking at here, or just discussing?
So I was thinking, I was drooling as you were talking to get the idea flowing. I think that from the takeaway here is that, so in the cloud space, right? The takeaway is that there is no currently, because we haven't talked about my definition of liquidity, but there is no traditional one answer fits all for liquidity. And so if anyone looking to learn about liquidity, if it feels confusing, it's because it is. Like everyone is talking about liquidity from a different angle, and they don't even really know it. They don't know that the view that they're expressing is sort of like a one that has a little bit of blinders on.
Mm-hmm.
So that's like, I think I would like to say is the main takeaway. Like, liquidity is difficult, but it isn't that the three like theories or ideas are invalid. They're just special use cases of liquidity. And other than that, honestly, from day to day, if from this view, it's difficult because there's a reason why I developed LDPM and LDPS. Mm-hmm. And it's because I couldn't find much alpha to squeeze out of these, even in like trying to clunk them awkwardly together. Because for instance, if we take this view, right, like if we take the idea that volatility is liquidity, right? That means some things that you can now no longer really discuss are things like gamma squeezes. Like this framework doesn't allow you to discuss gamma squeezes. It doesn't allow you to discuss short squeezes.
Yeah.
Oops. Like short squeezes. And anytime that basically there is a high variance, but it's actually being driven by good liquidity. And gamma squeezes, for instance, real quick, like think of a positive gamma squeeze, right? We talked earlier about the price insensitive and the price sensitive parties. In the gamma squeeze, the price sensitive party is the organic. Let's say the gamma squeeze is going up. That's what everyone likes, right? So this is the organic ask,
right?
And it's being met by the options dealers, right? Because they're hedging.
They're hedging, yeah.
Right, and because of this, so we will say option dealer hedging, right? Option dealer. So the options dealers are hedging and they have to purchase shares. Earlier, we mentioned how the price insensitive parties will always transact where they have to transact. The organic ask has a impetus, or it has a desire or an underlying I always want to sell higher. So the organic ask starts skyrocketing. Like, why increase your ask by 10 cents when you could sniff out there's blood in the water and there's obligation, there's option, but that's kind of the truth of it, right? So this ask is gonna zoom all the way up, right? It's gonna go do. But the option dealer is obligated; he has to hedge, and so the option dealer will always. I didn't get the zoom action correct. He will always move up to the ask.
I'm nodding my head because there's so much there in that part, the gamma squeeze,
right?
That I think we need to go through one by one, perhaps for another session. And especially, I think it applies a lot to crypto. There are lots that happen in that space. We constantly see these gamma squeezes. that happen. But most people talk about short squeezes only. I don't think a
Right.
lot of people.
Well, and I guess they're the same, but
Sort of
really,
the same.
but I chose options here only because like they are kind of a pure breed of like obligate transactors. Like their hedging, if for all intents and purposes, is strictly to hedge, and so they strictly will buy and sell to get that delta.
Yeah.
And since the delta of a share is always one, it doesn't matter what the delta they have is. They will have to always purchase and sell shares. So the short sellers though are a little in a mix. Like they're price insensitive in that like they have to transact in that they have to probably get out of that short squeeze, but they are a little price sensitive because they obviously don't want the price to go too high. They would prefer if the like price went down.
It's
But
too late by the
I would imagine in crypto, yeah.
it's happening.
But again,
Yeah, it's too late if the short squeeze is happening, right? In some cases.
right, fair. No, yeah, fair. Yeah, if you're already being squeezed, by the time you're being squeezed, it's like, oops, we took a wrong turn at Albuquerque,
Exactly.
But yeah, but like thinking like, and that's where these individual like ideas of liquidity, they excel in their area, but like they fall short when I think arguably when you kind of want a firm understanding of liquidity the most, which is during these crazy times. Like, what is it? Which the equity HZT? What is it? Maybe Hertz. One of them this week had two like back-to-back 40% days. That I would imagine if I was in that equity, I would really like to understand what's going on, but this isn't going to tell you. I mean, this from the idea that enter and exit, you can assume that it's bad. But again, the idea, maybe this was a gamma squeeze, so maybe liquidity was actually good. So this one doesn't really help because it's not going to help you discern that.
No.
And then the idea that liquidity is volume, maybe we don't know because was there high volume, was there low volume, and also does it matter? The stock moved 40%. So like which volume would it be that like tells us it was good liquidity? It really, I think, comes down to what all of these are really missing is what we kind of mentioned earlier. But all of these, the common theme that these share is they miss out on the idea of obligation. And because from obligation, you start getting ideas like if something is a eager bid, if something's eager, right? So is something transacting and crossing the book because it's required to? It has an obligation, and if so, how does that shape our view of liquidity? And so once you start baking an obligation into stuff, I think it gets interesting.
Well, obligations because you have to do it, right? No matter what, you just have to get out of that position, or you have to get into that position. It's very it's the key, right? You're defining here. Okay, we can see there are some complications here. It's not as easy as perhaps every other influencer is trying to tell you on the internet. So what can we do with this knowledge now?
Yeah, I mean, I think that LDPM and LDPS are the liquidity measuring tool, period, that at least is available to retail. I won't. If some of the financial overlords, obviously they have a direct tap into the flows of the market, so they probably don't need some of this goofy math. But in terms of so if you like a tool for measuring liquidity and analyzing it is LDPM and LDPS. Outside of LDPM and LDPS, I think the most beneficial thing is really just the understanding that if you do resonate with one of the traditional senses, or views of liquidity, just knowing its limitations and being okay with its limitations. Like it's not terrible if you're a trader and you say, no, I intuitively understand like this idea of volatility and liquidity. That's great. Use it. And most of the times it will kind of lead you in the right direction, but just know when those moments that it might not lead you in the right direction, when you might have to pause and say, okay, did I reach the limit of this tool? Because at the end of the day, all of these frameworks and concepts are really just tools, and so it's not to say you can't use these, but like if you're thinking, I'm just simply going to look at liquidity and the idea of like slippage, like can I get in or out of a position? Just be honest with yourself that you're kind of resigning to the idea that you're not going to know until you try it. I don't think there's any way that you can like piece, because I tried to piece like different aspects of them all together but I think it's actually better to just leave each one as like a view of a specific aspect of liquidity and just kind of respect them as that. Like, I don't know if it took 2 years to get LDPM and LDPS figured out, and it's almost an entirely different paradigm. And that's just to say, there was a good amount of time spent trying to salvage kind of these concepts. It wasn't just like, wake up one day and just be like, I'm gonna make a different tool for measuring liquidity. Like, it almost was birthed out of necessity. So yeah, I think that the greatest thing to do is just kind of that awareness, what is.
Yeah. And I guess just the last question I want to ask, how do you then track LDPM, LDPS, right? What are the, perhaps we can have one session where you can show us, but how do you track liquidity? Because that tool specifically focuses on liquidity, right?
Right. Yeah. So I would say the main principle is that it measures some aspect of the market performance, and really just it's a combination of the closing price and the volume.
I see.
But from that, it takes time, like the algorithm, like it's designed to parse out the price sensitive behavior and then the price insensitive behavior.
I get it.
And and then it kind of basically just goes through and its various algorithms. So first determining all of that, and then basically what does that mean, and what, because you can really only buy and sell or not buy and sell, but so many times. Like, for instance, LDPS is a state machine. So it's not like a algorithm that just produces some like numeric value. Like it exists in a universe that has specific states, and it can only move to those states under certain conditions. And so, yeah, that's kind of like the underlying with LDPM and LDPS. And it really comes, down to just working through these examples and saying like, okay, if I am looking at high volatility and I think that's good liquidity, what would the indicators be that maybe that's not the case? What would I start like seeing in the data? And so, yeah, that's kind of the way that LDPM and LDPS progressed.
In crypto world, you have these sentiment analysis, that tools that tells you if the market is hot or market is not, like this pendulum that shifts, if the interest is there or not. Is there any similar thing you can build for crypto, like using the liquidity metrics to show if it's a highly liquid or highly illiquid environment?
So yeah, for sure. So you can, so LDPM and LDPS will give you different results based off of the time interval that you analyze it at.
Right.
In my head, I pictured as LDPM and LDPS are like a microscope.
Okay.
So you can zoom in and you start seeing a lot of granular detail.
I see.
And or you can zoom out and get like an overview.
I see.
And so, and also with that, because it's a standardized way of measuring liquidity for any asset class, you can directly compare. Like, we could compare what is the liquidity on SPY versus the liquidity on crypto. Like, I use these tools, and like especially like the innards, I'm always like recycling to measure like the flow of liquidity from options dealers to dark pools to the lit market. And you can, because it's just, you're just measuring something, right? Like, I'm just out there with like one of those little like radar guns for how fast someone's going, right? It doesn't matter if you're on a bike, if you're walking, or you're a car. I'm going to get a number,
right?
And I can compare it to the other numbers,
right,
directly.
Awesome.